Neelkanth Mishra, co-head of Equity Strategy Asia Pacific and India Equity Strategist with Credit Suisse joins us now. Neelkanth, good morning. Thank you for joining us. The budget was good, but the market reaction was dull. So before we get into details of budget, are you surprised with what you saw in the market after such a decent budget, and even though everybody got much more than they wanted, the market reaction yesterday was rather dull. Post budget, the market sold off as if something really negative came out.
I don't think the sell-off was related to the budget, to be honest. I think the implications for equity markets from the budget anyway generally tend to be quite minor these days. Most of the reforms get announced outside the budget cycle. The budget is mostly a signal on what the priorities of the government are. And the stronger signal on the about the budget came from the bond market, where bond yields came off, and that was a sign that the bond market trusts the government's numbers and appreciates the government's fiscal conservatism. I think the market correction, as we were discussing with previous speaker as well, was more related to disclosures and the stocks related to and the decline in stocks related to a particular group.
Okay. Now the budget. How would you?
Not the budget.
Right. Let's understand the budget. The budget, in a sense, is growth oriented. But while growth is the priority of the government and capital expenditure, and there is a focus in creating that multiplier effect, do you think this budget, which is growth oriented, could also end up stroking inflation? Because that, again, could be a fallout of such a high growth dominated budget.
I would disagree that this is a growth-oriented budget, in the sense that if you are bringing down your fiscal deficit from 6.4% to 5.9%, you are actually reducing the support that the government provides to the economy. And it is a very timely support, meaning that as the economy then starts to come back on its feet, then the support that the government needs to provide is less. Now, where the government has shown, I think, positive intent is the quality of the expenditure. So there is a lot of savings in FY24, which is expected on food subsidy, fertilizer subsidy, the Narega payout. So as the job market normalizes, the demand for Narega work comes off, and therefore the allocations to Narega come off. The anticipated increase in PM Kisan payouts also did not happen. So as this occurs, there is some fiscal space that opens up, and that space has been filled up with very encouraging spending on capital expenditure. So this is the medium-term growth impact of this is going to be positive. I don't think in aggregate terms this would actually stoke inflation. This, in a way, if you think about 6.4 coming to 5.9 and hopefully 5.4 and 4.5, the government's support to the economy is coming off. So this is actually, in a way, slowing down the economy if you were to see it in isolation. So the inflationary pressures from this, I think, are extremely unlikely.
What about the big uptick towards expenditure for pockets like railways, especially? What would be the net resultant impact of that on the economy? And do you think the capex cycle, which already has started, let's say 18 to 24 months ago, will only strengthen further?
So the total expenditure goes up from about 42 trillion, so 42 lakh crores, to about 45 trillion, 45 lakh crores. Now, as a percentage of GDP expenditure, general government expenditure, remember that when we do this analysis, it is unwise to just look at the center. We need to look at center and states together. The combined expenditure to GDP is actually still flat, and therefore, at an aggregate level, the government is not really adding to demand. Now, as I said earlier, the quality of that expenditure is improving, but at an aggregate level, I don't think the government is adding to demand. Now, on the railways in particular, I have been a strong votary for a very long time that India needs to completely reimagine how much capex it needs to do in railways. In fact, I have been saying for now 2-3 years that instead of 1.5-2 lakh crores of capex that railways does, we should do 10 lakh crores of capex, because there is massive expansion potential in rail capacity, which would be very important to bring down logistics costs and all the long-term advantages that come with it. The challenge has been not availability of fiscal space, but the ability of the railways to execute that capex, to execute those projects. Railways has been for a very long time used to doing 5 crore, 10 crore local projects, and which are very hard to scale up. Now, what is happening encouragingly and has happened last year, and we are hopeful that this process will continue, is that the railways is for the first time last year managed, or this year, this fiscal year, managed to sort of absorb the capex and complete its funding, and also ask for more. Means that they are finally starting to ramp up on the expenditure in a constructive way, and therefore the allocation of nearly 2.9 lakh crores, if you add the extra budgetary allocations, is a very remarkably, I mean, it's a remarkably strong number. And that, I think, is, again, I mean, we'll have to see how rapidly the railways scale up on this. But if they're able to execute on that, I think this is very positive for our logistical costs. Imagine roads and rail both competing with each other. So lots of expressways, lots of national highways coming up at the same time, where and thus bringing down freight costs on the road, coming up at the same time as railways is expanding capacity. And if you prefer my bias is towards railways than roads, because railways uses energy which can be locally produced. Roads do not do that. So as an intent, I think this is great. If they're able to execute, I don't think additional 50,000 crores of capex in a 300 trillion rupee economy will actually cause inflation. But I think this will be very positive for the medium-term outlook for India.
Neelkanth, just drawing bits from what you've already said right now, the fact that you disagree that the budget is not growth oriented, but at the same time the government has at least made its intent clear that they are going to push capex. So what is it going to come at the cost of? Is the economy going to slow down, or do you think private capex will pick up?
No, but see, we cannot expect the government to keep spending and supporting the economy forever, right? Remember that our debt to GDP is still at 82, 83%. For it to start falling, our primary deficit, which is fiscal deficit minus the interest payouts, put it very simply, it needs to come down to 0.4, 0.5%. We are currently at 3%. So now, if the government does it too slowly, meaning that if the fiscal consolidation is too rapid, it can create its own problems, because economies like India cannot shrink into fiscal health, meaning that you cannot suddenly stop spending because your debt to GDP is too high. You have to support the economy, because the nominal GDP, the denominator in the debt to GDP ratio, has to be supported. So it has to be a gradual process. But you cannot keep it at that high level, because I think this level of primary deficit is unsustainable. So the government does need to slow down and allow the private sector to. So as I said, if the government needs to come in. I mean, if you look at pure Keynesian economics, only when aggregate demand is subdued. So during COVID, when everyone was saving a lot of money, someone needed to add to demand, and the government then takes up that responsibility. And as the economy opens up, as private sector demand picks up, as Nikunj was saying, private sector capex is now, there are very good signs that that's starting to come back. The government needs to pull back. So put it in a global context, right? So where are we? We are still in a situation where we have a very significant balance of payment deficit. Now, what that means is that our imports are too high and exports are going to weaken because the world is slowing. If that is the case, then you need to bring the balance of payment deficit down. So we are short of dollars. Now, for that to happen, you need to bring down fiscal deficit moderately. You need to use a variety of tools, so like higher interest rates, a weaker currency, and try to get some external capital. But anyway, so the first three measures, lower fiscal deficit, slightly higher interest rates, and a weaker currency, which can slow down the economy in the near term, all have to be used in prudence so that the balance of payments deficit is addressed. Because this is, so I think this is the key takeaway for me from the budget, that the government has preferred stability over near-term growth, right? And that is extremely important. If you see why India, over the past 1.5 years, despite massive macroeconomic challenges globally and financial market turbulence, has been a remarkably steady ship. It is because of this fact.
Right.
All right, Neelkanth, we'll let you go on that note. Thanks much for sharing with us your verdict on the budget, what you've made of it, as well as the kind of market reaction we've seen.